I warmly welcome all participating estate agents to the EAAB's 2017 CPD program, which is being presented by contact sessions, e-learning, and also a new innovation that we're hoping to launch in the second part of the 2017 year. I'm really gratified at the wholehearted support from professional estate agents that the EAAB continues to receive where CPD is concerned. The CPD requirement is prescribed by the EAAB both as the statutory regulator of the sector and also in fulfillment of its professional body obligations. It is to be underscored that CPD is an ongoing process that will continue throughout the career of a professional estate agent. CPD indeed is essential for ensuring the continued knowledge, competence, and retention of skills in any profession, including, of course, estate agency. It is axiomatic that the desired outcome of the major objective of any CPD program is threefold, namely, to protect the consuming public, to safeguard the professionalism of the sector, and to ensure that a successful professional career of choice for estate agents. It has always been self-evident to me that the estate agency sector is a dynamic and continually evolving one. Remaining informed of and being conversant with such factors as the latest skills, knowledge, and industry trends is therefore essential if real estate professionals are to remain relevant, meaningful, and probably just as importantly, successful. I am convinced that the EAAB CPD program, as it has developed over the past 2 years, is sufficiently focused to provide the necessary tools and content to ensure professional property practitioners are able thereby to develop and enhance their professional skill sets in relation to both long-term career plans and identified professional goals in an exciting career of choice. CPD is an essential mechanism that facilitates the demonstration by property practitioners of their ongoing commitment to keeping themselves informed of the sector best practice, whether for the benefit of the stakeholders, consumers, peers, and frequently current and potential future employers. In my experience, some of the many benefits attaching to the EAAB CPD program include the fact that CPD ensures the capability of estate agency professionals to keep pace with current standards and developments within the estate agency sector. CPD ensures that practitioners maintain and enhance the competence, knowledge, and skills needed to deliver a professional service to clients, stakeholders, and the community at large. CPD ensures that the knowledge of professionals is always relevant and current, and that practitioners are made aware of new developments and changing trends and directions in the estate agency sector, bearing in mind the increasingly frenetic pace of change that is currently being experienced. CPD not only assists professionals in the sector to make a meaningful contribution to estate agency in general, but also to become more effective in the workplace so that they may advance their careers, move into new positions, and ultimately lead, manage, influence, coach, and mentor others entering into the sector. CPD helps property practitioners to remain interested and interesting by creating and focusing on potential new possibilities, knowledge, and skills areas. CPD can inculcate a deeper understanding of the professionalism of estate agency sector and encourage a greater appreciation of the implications, aspects, and impacts of the services rendered by property practitioners. Interactive CPD advances the body of knowledge and competencies within the estate agency profession. CPD invariably results in increased public trust, confidence in, and respect for individual professionals in general as well as the estate agency profession in particular. CPD inevitably contributes to improved consumer protection as well as a sustainable increase in the economy as a whole. It must be accepted that CPD represents a career-long obligation for all practicing estate agency professionals. I believe that on a cost-benefit analysis, there can be little doubt that the benefits accruing both to estate agents and the consumers they serve resulting from the professionalization of this sector far outweigh the costs that are necessarily incurred. The EAB, with this in mind, will continue to strive to ensure that CPD compliance is not regarded as an onerous obligation imposed upon estate agents, but rather as a meaningful and valuable learning experience that provides food for thought and further inquiry and research, while simultaneously enhancing the professionalism, competencies, and productivity of property practitioners. I am confident that our CPD program for 2017 will meet these goals and obligations. In conclusion, I extend my very best wishes for the prosperity and success to our professional practitioners in 2017. I hope and trust that they will find CPD to be interesting, relevant, and helpful as they continue to play their vital part in advancing the professionalism of their careers in the estate agency sector.
Good day, I'm Tiaan van Berg from MCA van Berg Attorneys. We are an attorney firm in Centurion, and I'm going to discuss with you today the various forms of tax in property transactions. You'll notice that there are four. The first one is transfer duty, then there's VAT, income tax, as well as capital gains tax. The first one that we are going to discuss is transfer duty. Now, it's important to remember that on any property transaction, either the Transfer Duty Act or the VAT Act is applicable. What is important to remember is that these two are in conflict with each other. It's always either the Transfer Duty Act or the VAT Act, and never both. You will never get a transaction where the clients will pay transfer duty and VAT, but only one of the two. The Transfer Duty Act imposes a tax, which we call transfer duty, on any person or entity on the value of any immovable property in South Africa at the acquisition by way of a transaction. But there are certain exemptions that we are going to look at. The rate at which we pay transfer duty is regulated by the Transfer Duty Act, and the Minister of Finance changes these rates from time to time. Previously, we distinguished between natural persons and juristic persons. Currently, however, there is no distinction. All persons, whether you are a natural person, a company, a close corporation, or a trust, will pay transfer duty at exactly the same rate. Like I already said, it doesn't matter whether you're a natural person, it doesn't matter whether you're a company, a close corporation, a trust, or any other entity like a partnership or a club, you will pay transfer duty when you obtain property. Transfer duty is payable on the greater of the consideration payable on the property, the declared value if there is no consideration, or the fair value as determined by the commissioner. The value of a property will always include the commission. It will also include any municipal accounts that are in arrears that is payable by the purchaser. Estate agents must be very cautious when there's cash involved in a property transaction, that the cash is not paid under the table, and as such the value of the property in the contract is lowered. Also, when estate agents are asked to do a valuation on a property, that they not give a valuation that is too low in order to assist clients to defraud the commissioner. Transfer duty is paid on any real right in land, not on a bond, however. It's also paid when shares and membership interest in a residential property company is transferred from one person to another. The tax liability is incurred on the date of the contract. It is payable before transfer of the property, but if it is not paid within 6 months from date of contract, a penalty is applicable. It doesn't matter what kind of transaction is applicable. Even if the property is sold, if there's a grant, if it's donated, rights are waived, ceded, the properties are exchanged, or there's a renouncement of rights, transfer duty will be applicable to the transaction. There are, however, certain exemptions in terms of Section 9 of the Transfer Duty Act. The general rule is that a person or entity that acquires rights in immovable property will be subject to the provisions of the transfer duty. But there are certain exemptions, and I'm going to deal with 3 of them now. The first one is when there's an inheritance. If, for example, a grandfather bequeaths his property to a grandson, the grandson, although he obtains rights in immovable property when it's transferred to him, will not be liable for transfer duty. The same as I'm going to do this one again.
Okay, hold on. 5, 4, 3.
As an example, in the case of an inheritance, when a grandfather bequeaths his property to his grandson, the grandson will not pay transfer duty as it is exempted. Even so, when a natural person bequeaths property, for instance, to a trust, the trust will not pay transfer duty when the property is transferred into the trust's name. The second exemption is in the case of a divorce. When a court order dictates that half a share of a property or any share of a property must be transferred from one spouse to the other, the spouse that obtains the shares in the property will not be liable for transfer duty. A second example is where a husband, for instance, owns a property, the parties get divorced, and the whole property has to be transferred to the other spouse. No transfer duty will be payable. The next exemption is when there is VAT on the transaction. If a developer, that is a VAT vendor, sells a property to a purchaser, there is no transfer duty on the property but VAT, and we are going to deal with VAT right now. How do we administer transfer duty? Of all the taxes that we are going to deal with today, transfer duty is the only one that is actually administered by the conveyancers. All the other taxes are administered by the seller. In the case of transfer duty, the conveyancer will request the money from the purchaser. The purchaser will then pay the transfer duty to the conveyancer. The conveyancer will pay the transfer duty to SARS. SARS will issue a transfer duty receipt to the conveyancer, and the conveyancer will lodge the transfer duty receipt at the deeds office. It's important to note that even if transfer duty is exempted, a transfer duty exemption must be lodged at the deeds office. We've now looked at transfer duty. Let's take a look at VAT. Who pays VAT? Any entity that is registered as a VAT vendor. Sometimes I see that estate agents think that it's only a company, a closed corporation, or a trust that can pay VAT, and that is not true. A natural person can also be registered for VAT. If your turnover, your annual turnover is more than 1 million rand in a year, you have to register for VAT. Remember this slide? It's always either transfer duty or VAT, never both. The question that you have to ask yourself is, when you go to the spa and you buy a bottle of Coke, is there VAT on the Coke? The answer is yes. Does the lady at the till ask you whether you, as the purchaser of the bottle of Coke, is registered for VAT? No. And that is because VAT has got nothing to do with you as the purchaser, but everything to do with the seller. So VAT depends on the status of the seller. The question that you have to ask to determine whether VAT is applicable or transfer duty is applicable on the transaction is the following. You have to turn to your seller and ask 2 questions. Number 1, Mr. Seller, are you registered for VAT? The second, Mr. and Mrs. Seller, is this property that you are selling, is it a VAT supply? If either one of these questions or both of them is negative, then the Transfer Duty Act is applicable. Then there can't be any VAT on the applicable, and then you will look at the purchaser and you will say to the purchaser, you have to pay transfer duty as per the Transfer Duty Act. If both of these questions are, however, positive, then the VAT Act is applicable and there's VAT on the transaction. Then you have to determine whether your seller wants the VAT included or excluded in the price that he or she gave to you. The next one that we're going to look at is income tax. When a seller disposes of a property, hopefully he or she makes a profit. Tax must be paid on that profit. This tax will either be capital gains tax or income tax. You will never pay both income tax or capital gains tax on a property transaction, but either one of the two. It is therefore important to establish whether the profit that is made is capital in nature or income or revenue in nature. Because if the profit is capital in nature, the seller will pay capital gains tax. If the profit is income in nature, the seller will pay income tax. There are various factors that the courts will look at to establish whether the profit is capital or income in nature. They will, for instance, look at what is the seller's intention when he acquired the property, how frequently does the seller purchase and sell property, how long did the seller possess the property, what is the nature of the business of the seller, and in the case of residential property, did he or she claim the VAT back when they bought the property. Various entities pay income tax at different rates. A natural person pays income tax on a sliding scale between 0 and 41%. We call that the marginal rate. A company and a closed corporation currently pays income tax at a statutory flat rate of 28%, and a trust pays income tax at a statutory flat rate of 41%. CGT, or capital gains tax, was introduced into the South African tax dispensation on the 1st of October 2001. It is regulated by Schedule 8 of the Income Tax Act. All South African residents, regardless where the property is situated, will be liable for capital gains tax. Non-residents who have property in South Africa will also be liable for capital gains tax. All entities will be liable for capital gains tax, regardless whether the seller is a natural person, a company, a closed corporation, or a trust. Capital gains tax is payable when there is a disposal of a capital asset. A disposal can be defined as when a property is sold, when it is donated, or when it is exchanged. But capital gains tax is also payable when there is a deemed disposal, like in the case of death. Capital gains tax is payable on various categories of assets, like shares and immovable property, at which we're going to look at specifically right now. How do we calculate capital gain? Capital gain, or profit, is the amount by which the proceeds, which we're going to look at first, exceeds the base cost minus the annual exclusion. How are the proceeds calculated? The proceeds are basically the selling price minus the commission. So if you sell a property for 3,150,000 Rand and your commission is 150,000 Rand, the proceeds will be 3 million Rand. Let's look at the base cost. There are two ways that we can calculate the base cost. If the property was bought after the 1st of October in the year 2001, which is the date on which capital gains dispensation was introduced, there's a certain calculation that we will have to make, which we're going to look at right now. If the property, however, was bought before the 1st of October 2001, there are two methods to establish the base value as on the 1st of October 2001. If the client has done a valuation, which he or she had to do before the 4th of September 2004, you can use that valuation to determine the base cost on the 1st of October 2001. If not, the Act prescribes a time apportionment formula in the Act. But at the end, one must remember that the onus of proof lies on the taxpayer to prove what the value of the property was when it was acquired. How do we calculate the base cost? We start off by taking the cost of the asset on acquisition, in other words, the purchase price. Then we can add to that all costs that are directly related to the acquisition. Things like transfer duty fees, transfer duty, the cost of a valuation, plus any improvements to the asset, for instance, a pool or a jacuzzi. Let's look at this example. A person bought a property for 2 million Rand. He had to pay legal fees of 25,000 Rand. Transfer duty had to be paid in the amount of 65,000 Rand, and he added a jacuzzi to his property in the value of 40,000 Rand. The base cost of this property will therefore be 2,130,000 Rand. Let's look at the annual exclusion. Every natural person, every human being has an annual exclusion of 30,000 Rand capital profit that you can make each year, and you won't pay a cent capital gains tax. In the year that you die, you have an annual exclusion in the amount of 300,000 Rand if you're a natural person. Now, how to calculate your capital gain? We said that the capital gain or the profit is the amount by which the proceeds exceeds the base cost minus the annual exclusion. Let's look at a basic framework. If the selling price was therefore 3 million Rand and the base cost was 2,130,000 Rand, that will give us 870,000 Rand. Then we still have to deduct the annual exclusion in the amount of 30,000 Rand, and in this case the capital gain will be 840,000 Rand. How do we calculate the capital gains tax? Only a percentage of the capital gain, in this example that we have now, the 840,000 Rand, will be taxed. We call that the inclusionary rate. We will add that amount to the taxpayer's income, and the taxpayer will then pay income tax on that portion of the capital gain. Let's look at this example. If the proceeds in a specific transaction are 3 million Rand and the base cost is 2,130,000 Rand, the capital gain, like we said, will be 870,000 Rand, but if we deduct the annual exclusion of 30,000 Rand, the capital gain will be 840,000 Rand. Capital gains tax is not levied on the whole 840,000 Rand. Only a portion of the 840,000 Rand will be taxed. In the case of a natural person, and we are still going to look at that, the inclusionary rate is only 33.3%. Therefore, only an amount of 279,720, which is 33.3% of the 840,000 Rand, is taxable in terms of this dispensation. The portion of the capital gain in the amount of 279,720 will then be added to the seller's annual income, and the natural person will then pay income tax on this amount. When you calculate capital gains tax, there are two factors that you have to keep in mind. The first one is the portion of the capital gain on which tax will be paid. We call that the inclusionary rate. The second factor that you have to keep in mind is the income tax rate at which the person or entity that disposes of the property pays tax. We already said that in the case of natural persons, that is the marginal rate, and in case of juristic persons, that is the so-called statutory flat rate. If you multiply these two with each other, you will get to the effective capital gains tax rate. The percentage of capital gain that is added to income, or the so-called inclusionary rate, differs between the nature of the entity that disposes of the property. In the case of a natural person, it's 33.3%, and in the case of a company, a closed corporation and a trust, the inclusionary rate is 66.6% in this tax year. We've already looked at the income tax rates, but just to recap, in the case of a natural person, the income tax rate at a marginal rate or on a sliding scale is anywhere between 0 and 41%. In the case of a company, the statutory flat rate is 28%. In the case of a closed corporation, the statutory flat rate is also 28%. And in the case of a trust, the statutory flat rate is 41%. If we therefore want to calculate the capital gains tax rate at which a natural person can pay capital gains tax, we have to take the inclusionary rate of 33.3% and then multiply it with whatever income tax rate or marginal rate that specific natural person pays income tax. If you multiply 33.3 with 41%, you will get to 13.653%. Therefore, if your client is a natural person, your seller, and he asks you the question, at what rate will I pay capital gains tax? You will have to say to him, depending on your income tax and the rate at which you pay income tax, a maximum of 13.653%. A natural person can never pay more capital gains tax than 13.653% of the capital gain that he made on the sale of a property. In the case of a company and a closed corporation, remember that the inclusionary rate is double that of a natural person. So in the case of a company and a closed corporation, we have to take 66% and then multiply it with a statutory flat rate of 28%, and that will give us an 18.48% effective rate for capital gains tax. So if your seller is a company and a closed corporation and they want to know what will the capital gains tax be that they will pay, you can say to them on a flat rate 18.48% of the gain that is made, as we explained. In the case of a trust, however, we must remember that although the inclusionary rate is the same as in the case of a company and a closed corporation, the statutory flat rate is the same as a natural person's maximum rate. Therefore, we'll have to multiply 66.6% with 41%, and that will give us 27.31%. So if your seller is a trust and they want to know what is the capital gains tax that they will pay, you can say to them 27.31% of the capital gain that they have made. If we therefore have to compare the various capital gains tax effective rates, a natural person on a sliding scale, depending on what the natural person's income tax rate is, anything between 0 and 13.653%, a company and a closed corporation on a flat rate of 18.48%, and in the case of a trust on a flat rate of 27.31%. But there is something like a primary residence rebate. Every natural person, not companies, not closed corporations, and not trusts, if a natural person owns a property and it is registered in his or her personal name, he or she will have a rebate of 2 million rand on any capital gain that is made on his primary residence. Let's look at this example. If a natural person bought a property on the 1st of January in the year 2002 for an amount of 1 million rand, the base cost of that property will be 1 million rand. If he or she then sells the property on the 1st of January 2017 at 3.5 million rand, the capital gain will be 2.5 million rand. But because this is a primary residence and it is registered in the natural person's personal name, they will qualify for the 2 million rand rebate. Therefore, one will have to take the 2.5 million rand capital gain, deduct the rebate of 2 million rand, and then you will get a 500,000 rand amount that is taxable. We've already discussed, and I've already showed to you, that the maximum rate at which a natural person can pay capital gains tax, depending on their marginal income tax rate, is 13.653%. Therefore, in this case, if the seller is a high income earner and they pay income tax at 41%, the maximum CGT that they can pay will be 13.653%, and that will be an amount of 68,265% capital gains tax that is due. If we have to recap, when are these taxes payable? Like we already said, transfer duty is the only tax that is administered by the conveyancer. The conveyancers pay this tax to SARS before registration can take place. All the other taxes, the VAT, is payable by the seller, him or herself, at their first return after registration. Income tax is payable by the seller at the end of the financial year after registration, and capital gains tax is payable together with income tax at the end of the financial year after registration. Thank you for your time, and please remember to answer your 10 multiple choice questions in order to obtain your CPD points.